Okay, obviously, in every one of our teachings, we have to remind you that we're working with time and price. And one of the questions I want to lead in this teaching with is obviously, I've shared with you specific weekly profiles. And when I was teaching for free, I taught that there were market reversal profiles intra-week and intraday. And we'll talk about intraday when we get into day trading. But for short-term trading, there's intra-week market reversal profiles that for the uninitiated or the uninformed, they're many times caught off guard by the likelihood of a potential reversal. And early on in my career, I had these events as well, and it plagued me. It was one of those things that just kept coming up all the time. I'd have a trade, it was profitable, it would be working for me, and then something would happen midweek and it would completely reverse, and I would hope and pray that it would get back in sync with what I was expecting to see as a long-term trade. And it didn't happen. It came back and rolled right up against me and either stopped me out or pressured me so much that I had to get out of the trade. If you've never experienced this, you will eventually. So it's important that we cover it now. One of the hardest things for me to teach when it comes to market profiling is the market reversal profile, because I have to teach not just one element of trading or discipline of trading, but I have to teach a multiple approach, either swing trading, short-term trading, day trading, or position trading, swing trading, and short-term trading, something to that effect. So it can't be understood as efficiently as it would be as if the student or the trader was well versed in more than one trading discipline. So when I was teaching on the forums years ago, and I was sharing my information on YouTube and on my own website, the problem I was well aware of, but I wanted to kind of like lay some foundations so the folks that were really involved in learning and studying, they could have not get to the what I'm going to share here, but come to the conclusion that there are certain guidelines and approaches that leads to a potential intra-week market reversal profile. And we're going to cover the components that leads to that in this teaching here. Okay, in our example, again, we're going to be using the British pound. And this time, by having our PD arrays again, I want you to focus on this low right here. This actually happened the week of this recording, and it created what we're going to be talking about in this teaching. I was kind of waiting for this week to close anyway, so I can actually use this as an example. But if you go through the notes in this teaching, you'll be able to go back over historical data and see where they manifest themselves. And the criteria I teach in this lesson, you'll see that just like script, it follows it almost to the letter. So what we're looking at is the low that was formed on cable and the intra-week reversal and what led up to that and what are the characteristics that generally are a part of this phenomenon. First, we have to identify the fact that the market was in a premium market classified by the large trading range that we talked about and outlined in lesson 5. So we're in the premium range of the PD array matrix. And perhaps you saw that the market was trading up into the weekly rejection block or it traded up into an old bearish order block on the daily charts. Therefore, we could potentially see the market trade lower as we were anticipating potentially seeing this week, but it trades down into a lower level PD array in the discount. It doesn't do it over the course of the entire week. No. It does this in a matter of 24 hours. So as the market, in this case, the cable, British pound USD, trades over 200 points in a period of 24 hours. The market reaches for a level with speed for a particular reason. And when you look at the daily chart here, we've outlined the PD arrays, and you can see that there's a daily bullish order block mean threshold, and price reaches right into that on Wednesday of the week of this recording. When we see a fast market, we have to immediately assume that they're reaching for a level of institutional order flow that is highly critical for efficiency on the interbank level. Now, that may be in the form of commerce globally, or it could be in the form of a repricing at the central bank level. Either one of those could happen rather quickly. And while it took some time to gradually drift down over the 24-hour time period for that whole entire range to form between Tuesday going into Wednesday's low, the idea is you're going to anticipate at the beginning of the week a certain outcome. And it's prudent that you stick to that, okay? Because over the course of a career, you're going to get caught in a reversal like this once in a while. It's not going to plague your career, obviously, after learning what's being taught in this lesson. But you'll also have a checklist on things that may lead to that type of scenario. And if you go back over to the chart index and look at some of the examples we were talking about as it relates to the cable, there were telltale signs, and I gave you a little marker telling you that there was a potential area of bounce likely in this pair. What led me to that are the things that I'm going to teach you in this lesson, because I understand multiple dimensions of trading, whether it be position trading, short-term trading, swing trading, day trading, scalping, all that business. I am versed in understanding and reading price universally. It's not one type of time frame to me that makes sense. It's all the time frames. I know how to blend them together. That part comes with experience. And after a measurable growth in your experience and working within different disciplines of trading, this is the reason why I tell you, regardless of whatever you think you want to be at the beginning of the mentorship, it's going to graduate into other things. But I'm forcing you across all of them if you're willing to submit to all of them and stay with the mentorship. Again, that's not a plug. You decide whether you're staying here or not. But by having a well-versed approach and understanding across all the disciplines, you inherently have an advantage over those individuals that just stick to just one format or discipline of trading. I'm a scalper. I'm only going to worry about scalping. Okay, well, then you're not going to be that good at scalping because you have a limited myopic view on price action. So having a well-rounded approach to price action, multiple time frames, different disciplines, you will, by default, be a better trader at whatever discipline you focus on as a career. So we're going to look at this little range in here. Now, it's not so much of a little range, but we're going to look at the move in this particular decline down into the daily bullish order block mean threshold and what the catalyst that led to that reversal. The first thing you want to notice is that price is unwilling to leave the premium. So we're in the upper portion of the larger trading range defined by in lesson 5. So while we saw initially in the beginning of the week the market want to decline, and it was doing it aggressively and speedily, if you will, by seeing that, we could have, if we didn't understand PD array matrix discount arrays, we could have easily expected this market to keep on trading lower, maybe even going down to the fair value gap. Or if you're a classic support resistance person, maybe just that old low made back in January. Myopic, I know, but nonetheless, this view leads to what many times breaks accounts, it ends careers, it dashes the hopes of would-be traders because they aren't informed. You're learning the mechanics of how price is delivered. We're going to look at this range here and define it in a context that would otherwise not be available to you. So we're going to look at the first 2 days of the week going into Wednesday's low. And I want you to understand just how much that price range is. It's extraordinary. Look at the length of that candle. For the most part, it's many times larger than the general average of all the candles here. Now, obviously, there's a few of them here that are larger, but in general terms, the candles slightly before it and the candles to the right of it, that large down candle on Tuesday, it's pretty much a dominating candle. So it was speed at which it moved in one trading day to get down to a specific institutional order flow reference point. We're going to take a closer look at this, and we're going to look at a 4-hour chart, and we're going to refine it and give it a little bit more detail. The yellow area is that same range defined across the entire week from Monday's rally, Tuesday's decline, into Wednesday's low. And price returns to a discount PD array reversing intra-week. Now we can see it clearly here. It's hindsight. It's perfect. It's 2020. We can see it. But we have to go into it with the details because that's what's going to help you see what it looks like going forward. Why did we anticipate a bounce there? Why did I give it to you in your chart index this week? To the things I'm going to show you here. I want you to take a look at the low here, and it forms on Wednesday's market low, and it's trading at a daily bullish order block mean threshold. After the bounce at the daily bullish order block mean threshold, IPTA draws price up into a 4-hour bearish order block premium PD array. Notice the efficiency, how it trades right up into it. It's exactly right to the logical area where price should reach for if it's going to a premium market. There's very little movement below the level that's identified as the daily bullish order block mean threshold, and it trades right to the 4-hour bearish order block. You can't get any better than that in terms of price delivery. Clearly seen with the 4-hour order block traded here. So now we're going to take it, refine it down to an hourly chart and give it a lot more flesh on the skeleton we're outlining as a market reversal profile. I want you to note the large decline from the first of the week. Now, obviously, I'm beating this in your head because this is the classic telltale sign that you have a potential market reversal profile. Think about it. Every time that the market quickly starts trading on Monday or Tuesday aggressively and speedily, that's usually a telltale sign it's in a hurry to make a weekly range, or it's going to go to an institutional order flow reference point that could potentially cause it to reverse and go the other way. So now we can see Monday starts as a potential high of the week profile, rallies initially right from Sunday's opening, declines a little bit, and then we have another rally into the London session on Tuesday, and it aggressively trades lower, trading right into the changeover from Tuesday into Wednesday, creating the low of the week, and then we have an aggressive move off that low. This right here, this price decline, the speed at which and the magnitude of which it moves is the telltale sign. That's the characteristic that leads you to, okay, we're really moving quickly and we're covering a lot of ground in the beginning of the week. Whenever that happens, you immediately start looking for higher time frame PD arrays that may cause or be a catalyst for an intra-week market reversal profile. If you do not do this and you fall into the thought process that, okay, it's moving quickly, it's moving fast, so therefore I'm going to make a lot more money in double time, and it's probably going to have an equal leg, lower later in the week in the same move. No, don't think like that. Okay, don't think like that at all. Speed in price is indicative of them getting to a valuation point. When price is in a hurry to get somewhere, think about when central banks reprice. For instance, when they do interest rate announcements, okay? There's very little time from where right before the announcement, then the news comes out and then the rate changes. That is not attributed to buying and selling, okay? That's a repricing based at the central bank level. It's a sudden thing, and that's why there's such a wide disparity between where price is at one moment and then all of a sudden it's somewhere else. That repricing is a response to a central bank intervention or interest rate announcement. When there is no central bank involvement and price is just aggressively and speedily moving, okay, that's based on evaluation through speculation. So they're taking the market down through IPTA, in this case, down to a daily premium to discount range. In other words, it's moving away from a premium down into a discount PD array. But we're still in the larger premium range. So if you were just looking at price and you understood overbought, oversold, this would look like it's probably going to keep going lower. It's going to continue going lower. But no, the only thing it's doing is it's showing a willingness to get back down to a discount level. Okay, think about how I showed you in the previous lesson, how you can grade modular, smaller ranges in terms of premium and discount arrays. That same thing is being used here, but just in scope of keeping it in the upper portion of the premium range on that daily chart that we broken down in lesson 5. So while we're still overall in a premium market, longer term, short term, it can continuously move higher and keep making higher highs. Think about it like when you trade with bearish divergence. Just because the momentum indicator is diverging bearishly doesn't mean price is going to say, okay, well, I'm going to turn around and go the other way because of stochastics or MACD. It continuously can keep moving higher up. That same element takes place when we're looking at just price action alone. So while we are in a premium market, the market is showing a willingness to not, here's the key, not move out of a premium market. In other words, why didn't this continuously go lower Wednesday into Thursday going into the discount market? Because it needs to go higher. It wants to go higher. So if it's not going to go lower and it wants to go higher, where do we focus? We focus on premium PD arrays. Now Wednesday breaks a short-term high, and then we start seeing evidences of institutional sponsorship on every bullish order block. Every order block that forms with a down candle or a series of down candles, we extend that out in time, and you can see them capitalizing, each one of them with new long positions, and we're seeing a positive confirmation because price is quickly surging away from that level. Every instance, we see new evidences of institutional sponsorship and up into a fair value gap premium PD array. Now, intra-week reversals will many times look to return to the previous balanced price range or exceed it. Now, what does that mean? Think about the market maker sell and buy profiles, okay, or market maker sell and buy models. In this case here, this could end up becoming a market maker buy profile. We have the consolidation known as, in this example, as the price balanced range. In other words, price is in a small little range and then it leaves it on Tuesday. Aggressively sells off. We have the smart money reversal in the Tuesdays, Wednesdays overlap. Then we have a low risk buy on Thursday. And then we have a continuation or reaccumulation on Friday. But price is traded up into that price balance range all over again. It's right back up at it again. So when we see that, this could be the end of the move. It can be. This could, all that's been necessary is for them to trade right back up to that price balanced range. But we always have to have the likelihood on our mind that price may exceed it and go past it, which is what the market maker buy profile really aims to do. It take out the liquidity above and on high. In this case, we have a lower high formed on Tuesday than Monday, so it may not necessarily need to go above it, but personally between you and I think it will. So here we have a British pound naked 1 hour chart. Now, if we were just given this example here in price action, maybe some of us would be able to see that low down there and see some evidences to support why it should go up. And then maybe not. Whenever we have a storyline or a potential outcome in the marketplace in our mind, that we formed an opinion, we have a plan that we're going to try to execute on, it's important that we're mindful that the setup may not pan out. For instance, at the beginning of this week, You may have seen this as a potential high of the week, and you expected to see Friday's close be lower than Wednesday's low. Guess what? Just like I do sometimes, you're going to get it wrong. The evidences of the fact that the market's moving quickly at the beginning of the week, this is Monday and Tuesday, okay, or one of the two. If we see sudden, quick movement in price and magnitude, here's the key word here. It's got to cover a lot of distance. What's average distance of the last few days? If it exceeds it a lot, whatever the average daily range is for the last 5 days, if it gets well above it, chances are you're probably going to see a market reversal profile. It doesn't mean it always will happen. It just means that start considering it. Okay. I mentioned in the commentary through this week that we were probably going to see the weekly range form in one day. And we did. We pretty much ended up seeing that, with the exception of a small little tail noted here on Monday's high. The whole range for cable was really formed on Tuesday. So that's indicative. It's characteristic of a market reversal profile intra-week. So the main thing I want you to understand in this lesson is that at the beginning of the week, we anticipate the higher low to form, period. That's a given. That's the nature of ICT concepts, because as humans, we're generally good starters. And the week starts with the new hopes and aspirations to make money in exchange and commerce. But opinions can change, directives can be changed, and the central bank and the banks themselves, they can make policy changes, and or fundamentals may change that we're not aware of. And yes, you heard that right. I don't know what they are that causes price to change at the central bank level. I don't need to know it. I can see the evidences of it in price. So when we move forward and going through price action study, it's important that you understand that knowing the higher time frame PD arrays will aid in failures. That means when you have a trade that doesn't seem like it's working out for you, even though you're profitable, chances are it's probably better for you to get out of it and look for another entry point. If it doesn't give you a strong entry point, chances are it's probably going to be a market reversal profile. Wednesday or Thursday reversals generally form every month. So no matter what pair you're looking at, there's generally some kind of a reversal of sorts that can form. So by going over examples and looking at price hits, you'll see many more examples than just this one here. And everything we're showing is reversed when there's an intra-week market reversal profile that goes higher and then sells off. So it's a generic concept. It's very simple things that leads up to it. The classic telltale signs are the magnitude at which the price moves on Monday and Tuesday. Okay, so it's only 2 days you have to focus on. How much is price moving on Monday and Tuesday? So if you're seeing a lot of movement in your favor and it's really covering a lot of distance and it's doing it quickly, many instances you're going to see it, like this week, really built in on one trading day. When it does that, consider the higher time frame PD arrays, because it's probably going down to a valuation or a higher level valuation point, and then it's going to have a lot of sponsorship come in, and that those flows are going to turn the market. It's going to turn it the other way. And if you fight that, it can beat you up, or dare I say it, break your account. Now, consider swing trading model overlap possibilities. Now, we've talked about the likelihood of using short-term trading concepts and one shot, one kill. And now we're going to blend or overlap trading models. So it helps you kind of formulate a better understanding. Here we have that same area of price action. And what I've done was I've outlined it in terms of a premium and discount PD array matrix. So we can see in the green area, that's the discount area. And I have it graded as well with 4 grades or 4 quadrants. And the premium area is posted and it's divided as well. Notice that on the daily chart, we have a daily bullish order block. It's trading down into that. So if we look at this model here, think about what I taught you in the swing trading model. This is a swing trade entry. This is exactly what you look for a swing trade. Now, if you're not a swing trader, if you don't think like a swing trader, then you're not going to see this as a swing trade entry. You're not going to see it as a potential setup that could many times pay out much more than what a one-shot, one-kill would. If you're only focusing on, I'm going to be a short-term trader, or I'm going to only be a day trader, or I'm only going to be a scalper, these types of setups will evade you. And by evading you, it's also going to become a pitfall for you. You're not going to know when there's going to be these potential reversals. You'll get caught off guard. So now we're going to take that same element, everything we saw in the daily chart that was just applied, we're just reviewing it from a 1 hour standpoint so we can see the intraday price action on a day-by-day division. You can see here reversals intra-week, they occur, here's the secret, they occur in overlapping models. Every market reversal that happens intra-week will be a overlapping of two types of trading disciplines. They'll be at odds with one another. Here's the rub. The higher time frame discipline will always win. That's why we have to focus on monthly, weekly, and daily PD arrays. That's why I've beat it in your head that they are the most important ones. Anything less than that, 4 hour, that's about as low as you want to go. Anything less than that is all day trading stuff. And if your day trading things are not in alignment with the higher time frame, daily, weekly, or monthly, no less than a 4 hour, you're really not trading high probability setups. So it's important that you understand that the reversals are not always going to surprise you now because you have some characteristics to look for. And now by having an opinion of not just one shot, one kill short term trading or swing trading, but you have position trading as well. And by blending all those elements together, it gives you a greater understanding about price action. And now, because you have these characteristics in each discipline understood, when you see a opposing view, if a swing trader's approach saying it's a buy, when you're looking at a one shot, one kill sell off, chances are your weekly range phenomenon that you're trying to trade is going to have opposition to the degree where it will cause a reversal, as it's being shown here. So daily swing model overlap example shown here will hopefully ground you in your understanding about how intra-week market reversals occur. Takeaways from this lesson again are the speed at which price moves on Monday and Tuesday, the magnitude at which it moves. There's your number one characteristic, telltale sign. You're probably going to see a market reversal intra-week. And look for overlapping opposing trading models. If one is suggesting a buy on a higher time frame, while on a lower time frame, it's looking like it may continue going lower, the arm wrestling match is always going to be won by the higher time frame. So hopefully you've learned something that brings you closer to a greater understanding of price action and intra-week reversals and blending and overlapping trading models.